Well, every dog has its day. Every investment category has its fun times and not so fun times. Right now, property is the one that people are looking at askance and saying, will it ever recover? Kanyane Matlou, who's the senior portfolio manager for listed property at Terebinth, has got some pretty strong views on that topic. We'll be finding out from him all about it in a moment. And this interview is brought to you by Terebinth, one of the platinum sponsors of the Fantasy Fund Manager competition. Kanyane, good to have you here. Property is your speciality. I see you trained as an economist if I read your background properly, worked at the Reserve Bank as an economist, the BR, Bureau for Economic Research. So going from economics to then working at Coronation Fund Managers and now at Terebinth, that's not a normal process, one would have thought, from economics to asset management, or is it?
It is not sort of the norm per se, but essentially from my point of view, in terms of what I wanted to do, it actually fit in with what my goal and my plan was. So you're right, I basically studied an economics degree at the University of Cape Town. Then afterwards, I was lucky enough to join the Bureau for Economic Research down in Stellenbosch in the internship program for economists, after which I went to the Reserve Bank and joined the modeling team there. I did a lot of macro research, sort of modeling the macro variables that the MPC essentially looked at for their decisions for interest rates. And then from then, I was interested in essentially how sort of this macro research essentially fed into the financial markets, how allocation decisions were made. And that's when I decided to make the move to Coronation, where I was part of the fixed income team. And essentially, as property sort of straddles sort of fixed income and general equities, it was a natural fit for me at the time. Property was in its heyday. Every other week, essentially, there was a listing, there were accelerated book builds, and there was essentially an opportunity for me to join the property team at Coronation, which I grabbed with both hands. And essentially, that's how I made the transition. But I think, in essence, because of sort of the qualities and attributes of listed property, especially from a yield point of view, being an interest rate sensitive asset class as well, it lends itself to sort of that fixed income categorization as well, which is where sort of I made the jump, which for me was essentially seamless in a way. Yeah.
Some interesting parallels there. When I started in financial journalism, and you'll appreciate this, the old heads, the wise old fellows, Harold, Fred John, Howard Priest, these guys who were icons of the era, said to me, you have to write about money and capital markets. Now, you can imagine a greenhorn who didn't know a heck of a lot coming from a little town. What were the money and capital markets? But I'm ever grateful that they did that, because if you understand the cost of money, interest rates, what make them move, then it really gives you a wonderful background for so much else. And in your case, not only did you understand that, but economics as well. So I guess, given that property is so dependent on what happens in the economy, it's about the most perfect background you could have asked for.
Absolutely agreed. And yeah, essentially having had that macro underpinning, and then at the time basically having joined a house that essentially is focused on the fundamentals, I was able to essentially gain the skill set as well from the bottom up side. So it was essentially one of those moments where I'm grateful for in terms of how stars aligned to actually get me into the sector, and yeah, to find myself here now.
Terebinth is a boutique, very specialized, good bunch of guys. It's almost like you've gone out and picked or been cherry picked by the colleagues that you joined. Do you have a collegial type of atmosphere, or is it very different or similar to what you had at Coronation?
I think it's a smaller house. It's basically a much sort of closer knit grouping, family of sorts in a way. I think having come from basically a slightly larger house, I think at Terebinth, essentially we way more nimble, essentially because of the team being sort of the size it is. We're able to wear multiple hats as sort of the individual members. So you don't necessarily just focus on the area of specialty that you're in. And that's why also like sort of the appeal is still there, that I'm able to essentially do a lot of research on the macro side, but also focus on property. And then across the business, also there's other areas of responsibility, and it's like that for most team members as well. So I think this sort of boutique culture essentially allows one to be proper entrepreneurial. You're able to do a lot more than what your sort of assigned duties are essentially are on a day-to-day basis.
Well, every investor likes to find an angle, likes to find something that nobody else has gone for, and often digs in areas that are out of favor. Property's out of favor. Are you out of favor in your office? Are they asking you to do other work, or are you finding that there's lots of potential now?
No, there's definitely a lot of potential. At Terebinth, just to give a bit of background, because we essentially subscribe to the theory of cycles, we are a macro house, and we appreciate essentially the macro environment and essentially where we are in the business cycle and the opportunities that various points in the business cycle sort of present. As a house, actually, we're quite constructive on the sector. Essentially, to give you background, essentially our view is that we've had over the last, call it 18, 24 months, a once-in-a-generation development in inflation. And on the back of that, you essentially have had this massive response by central banks across the world in an almost synchronized way. And essentially, the end goal of all of this tightening eventually is that we're going to see something break in the economy. And at some point, even though for now, policy essentially is adopting a higher for longer type of stance, eventually as sort of the macro response, which it hasn't done so much up to now, but eventually when it does, you're going to see central banks essentially reverse course to some extent. It may not basically go down to the lows we saw sort of over the last 10 to 15 years. However, there's going to be some normalization and a point where we have basically an easing cycle sort of starting. And at that point, an interest rate sensitive sector like property essentially will be well placed to actually benefit from that. So to just give another sort of bit of background, where we sit in the local property sector in South Africa, we've seen in the reporting season that's currently underway, a lot of companies that are actually reporting an improvement in fundamentals on the property side in SA. So in retail, in industrial, in office, though not as much as in the other two, we're seeing some green shoots, and some management teams are actually talking about us having bottomed out. But the only sort of negative contributor to at this point remains essentially the interest rate cycle and the environment, where the higher for longer essentially is hurting your earnings, because essentially are paying higher interest rates when your interest rates reset, even though the sector has, call it 75 to 80% of their interest rate hedge. However, this 20% that's variable is taking a lot of strain due to this higher for longer environment. As those sort of news get baked into the price, share prices essentially have been quite depressed. And we believe that at current valuations over the medium term, essentially you sit at a point where there's essentially an opportunity that over the medium term, these are very attractive entry points. And then when the cycle eventually turns, you'll have actually picked them up at compelling valuations from both a yield and a sort of discount to NAV point of view. So we're quite constructive on the sector, and we believe that essentially over the next, call it 1 to 3 years, it can actually give investors compelling returns if we pick basically the right opportune moments to actually gain entry into the sector.
So if I understand you correctly, it's time to be accumulating now. You don't know where the bottom is. It probably hasn't bottomed yet, but nobody rings a bell when you hit the bottom.
100%, yeah. So it's very difficult to time the market, and essentially because the stock markets are forward looking, at some point you're essentially going to start looking past sort of this bottom, but the point is to have exposure by the time that happens, because if you're not in, essentially things can develop quite quickly, especially because we have a global environment where things are quite uncertain and things can move in other direction rather quickly. But if you have exposure, if you're in it already, then when that moment arrives, essentially you basically are able to participate in the upside. So I think essentially our view is that it's key to go in. Valuations where they are already, I think that sort of the risk reward trade-off is skewed to the upside, because you've already seen substantial sort of headwinds to the sector. And if you look at how it's fared in the year to date compared to the other asset classes, it's basically lagged. And for that reason, we basically believe that there are specific opportunities that the sector offers compared to what essentially you see in either general equities or in the conventional bonds within the SA market.
Is all the bad news baked into the share price then?
It's always difficult to say if all the bad news is baked in, but I would say we essentially approaching a point, if not already at a point of peak pessimism. So again, to your point that you can never pick the bottoms, it's possible that basically over the rest of the year, we see some slight sort of downward movement. However, essentially where we are on a net basis, I think the upside potential certainly would outweigh upside potential would outweigh what the downside would potentially give you. So yeah, it's difficult to say whether the bottom has been reached, but you never know.
Peak pessimism. It's very easy for me to roll out a whole bunch of negative issues, but there's always another side to it. What are the positive signs that you're seeing?
So I would say on the positive side, you have to break it down into the various sectors. If I can sort of go into it, I think if we look at the most interesting of the traditional sectors, certainly the industrial, or what are essentially better sort of described as logistics assets, are in a sweet spot. You have two factors on the supply side that are aiding essentially the fundamentals. One is that you've got a scarcity of land, whether it is in KZN, whether it is in the Western Cape or even Gauteng. There's very limited sort of industrial zone land where essentially new supply can come from. And then the other factor is that because you've seen inflation over the last, call it 18 to 24 months, construction costs have also gone higher. And essentially that has prevented a lot of developers basically bringing on speculative developments because the costs are essentially elevated. So from that point of view, you don't have a lot of new shares coming on stream. And as a result of that, essentially supply is limited. And on the demand side, you've got retailers which are rolling out essentially e-commerce strategies. You'll know obviously on the Woolies side, the Woolies Dash Checkers 6060, Pick n Pay has partnered up with Mr. D and Take a Lot for their delivery. So essentially that e-commerce strategy rollout essentially supportive for these distribution warehouses, etc. And essentially also like supply chain optimization in general is also supportive from the demand side. So if you look at the logistics sector in general, it is in a sweet spot where the fundamentals are essentially supportive of rental growth going forward. If you look at retail as well.
Sorry, Kanyane, before you go there, so
sure.
Which are the stocks that would be appealing in the logistics area?
Okay, so in the SA context, the one specialist counter that is purely sort of logistics focused is Equites. And then basically then within the other diversified portfolios, there will be pockets of logistics exposure. Sort of the next best one would be Fortress, which has a substantial logistics portfolio as well. And the other larger ones, essentially, whether it be Growth Point or Redefine, also have exposure in the region of, call it 20% of their SA direct portfolio within basically logistics, the logistics sector. Yeah.
You've made a very strong point for Equites, so that's one we must put into the notebook. On to retail?
Yeah, so on the retail side, it's key to differentiate between, because like not all properties are the same. So you've got on the one hand rural assets versus those that are in urban areas. And within those, you've got different sort of qualities or a different makeup of the, call it the consumer. Some are obviously servicing the higher LSM consumers, some are in the lower SM categories. And you see quite a lot of difference across those type of assets. So in the rural areas, it's mostly about those that serve essentially essential items. It'll be your food, it'll be your groceries. So those generally tend to be quite defensive through the cycle. And you saw it even through COVID and coming out of COVID. These sort of rural centers are the small ones, especially where essentially the first to recover from essentially a trading density growth point of view, as well as the ability to grow rentals upon renewals. So those were the main beneficiaries are coming out of COVID. And then the ones that are sort of the larger format one with a sort of more discretionary type of tenants, whether it be leisure or entertainment, and basically larger sort of fashion offerings are essentially the likes of your Sandton City, your Mall of Africa, and so on. They were slower to recover. However, we've seen in the sort of the latest reporting season that they've also come to the fore, and the negative reversions of, say, call it the double digit in the negatives have basically compressed, and you're seeing numbers closer to sort of the mid-single digits with essentially outlooks that we could start seeing as positive rental growth over the next sort of 18 to 24 months. So certainly on the retail side, there's all of those nuances. But like the general trend from a fundamental point of view, notwithstanding the sort of the tough macro and the pressure on the consumer, I think given the low base that we come from, given the tough lockdown periods of sort of the COVID period, there's actually a lot of sort of upside because there's been a lot of rebasing in rentals, but going forward, there might be potential for good growth in those rentals, especially if you look at the rent to turnover ratios that the landlords report, which are at healthy levels and should be supportive of rental growth going forward. And then the last one on the office side, it remains sort of the lagging sector of the three traditional ones. Essentially, that is a story of oversupply, especially in the Gauteng node, specifically Sandton. You've got vacancies that are elevated, specifically within Sandton, and they sit higher than the national average, as reported by sort of the SAPOA office vacancy survey. They actually came out with the latest number for Q3 of 2023, which shows that vacancies at a national level office vacancies, that is, have compressed to about 15.5% nationally, and this comes from a peak of 16.7% in the second quarter of 2022. So you've seen some compression, but it's a bit slow, and that's due to the oversupply in the market. And then on the demand side, what you have is that essentially the office market is very cyclical. It's very dependent on GDP growth. It's very dependent on employment growth as well. And unfortunately, because of the challenges we've had in South Africa from a load shedding point of view and the level of GDP growth, unfortunately, it's a bit difficult to see the office sector reflecting a recovery alongside the two other sectors. So I think it's going to be a bit of a slow bleed over the next couple of years until such point that we get economic growth essentially being sustainable and high enough to essentially support demand and space take up to essentially make up for the oversupply that we see in specific nodes.
It's such an interesting sector because you do have these very different outlooks for them, as you've mentioned now about offices. Correct. And I guess it's very easy for people to say, but yes, there's a hybrid factor, work from home. We saw Meta, for instance, paying £149 million to get out of its lease in London, which obviously Correct. We saw there. Yeah, but getting back to the retail side, I like the story there. What are your picks of the property listed stocks in the retail sector?
In the retail sector, there's so speaking to the point of the sort of small convenience of centers, which are basically like they will be dependent more on your sort of non-discretionary type of tenants and that type of spend. I'd say currently, given the valuation as well, there's a counter called SA Corporate, SAC. Over sort of the last few years, it's done a good job of actually rotating into these type of centers and has done a lot of work in putting proper capex into these centers. So I would say from a valuation point of view, it looks quite attractive. And in addition to that, I think it's basically a story across the whole sector. It's not just on the sort of, you don't get specific exposure to one sector. The advantage is that it also has inner city sort of residential exposure. It recently acquired a specialist residential counter called Into Place, which has exposure sort of to the inner city of Joburg and some sort of suburban properties. So I think the combination of those essentially, even though this year they're going to report sort of negative growth in sort of the mid-single digit level, going forward, we basically believe that that exposure on the retail side combined with sort of the benefits of the residential sector as well should benefit the counter, especially given where it trades. Essentially, you're getting a yield close to about 13-14%, and it's essentially trading at a discount to NAV of about 50%. So from a valuation point of view, it's quite attractive. And I think, essentially it's one of those picks compared to at least the other ones within retail that are perhaps not screening as cheap as a corporate. So that's one we like in retail, yeah.
Kanyane, I can see you know your business. Kanyane Matlou is with Terebinth, and I'm Alec Hogg from BizNews.com.